How's it going, everyone? This is Wade. I want to welcome everyone to this morning's webinar, or this afternoon or evening, wherever you're located in the world. Appreciate you guys being on. I'm actually going to before I start talking, can we just do a quick sound check? Let me know you guys can hear me all right. You just simply type a Y into the chat. Want to make sure our sound's good. So we'll give a few seconds here. All right, looks like we're good to go. Perfect. All right, guys. So I'm actually, guess what? I'm going to be introducing Shane this morning because one thing we talked about is you guys, believe it or not, Shane's the one that puts the most work into the volatility report, and that's kind of a constant feature that we like to have, that we like to talk about, on each webinar because it comes out obviously the day before. And Shane by far does the most work putting that report together for you guys and sending it out. And doing the research on it. He puts a lot of work into it. So I thought, he's the best one to go over and do the comparisons from the previous week and everything. So anyway, he's going to go ahead and go over that with you guys. In the meantime, if you guys have questions about the volatility report, you can type those in. But once he's done with that, and I'm assuming it'll probably run him, I don't know, somewhere between 15 and 30 minutes to go over that. You guys can go ahead and type in other questions because after he's done with that, I'm going to come back on and answer you guys questions about markets. I know we have a number of new people on with us, so if you guys have questions about the software, or specific things like that, this is, somewhat of a beginner's webinar, so we want to make sure you guys are getting up and running and understanding what you're supposed to be doing. So you guys can go ahead and type in some of those questions as well, and I'm going to be kind of, while Shane's talking, I'm going to be looking for those questions and figuring out which ones we can fit into to address once I come on. So anyway, but that's pretty much what we got planned for you today. So with that being said, I'm going to go ahead and introduce Shane. Shane, go ahead and take it away and tell us about the volatility report this week.
All right, perfect. Thanks, Wade. Just to one little check of my own, just to make sure. Can everyone see my screen all right? I've got Euro Aussie up. Just go ahead and type in a Y. Perfect. Thanks, Kirk. Okay, so let's go ahead and jump into this. As Wade said, I'm the one that mostly does all of the work for the volatility report. So we'll just kind of go through and kind of do a little explanation about what we saw going on here. Woo, lots of comments. Thank you, guys. All right, so the first pick, so actually, I want to preface this with kind of talking about this week's volatility report. For those of you that have seen it so far, I'm sure you'll notice there's only 2 on there. The whole point of the volatility report is to give you kind of what our take is on pairs that are going to be moving, not show you all the action that you missed. So, anybody can look at, the market right now and see that things are obviously moving. It's a little bit trickier to find stuff that, we think has still got some opportunity. So you're not looking back at it and, jumping in at the tail end of some big move or something. So things that are starting to move instead of everything that you missed. So anyways, the first one that came up, the first of 2 is Euro Aussie. So this one did go into a box, which there's not very many of them right now. Got one on 15-minute. Let me make the time frames correct. So I was pretty blown away when I was putting this together. I didn't catch or not. I haven't gotten any screenshots about anybody catching any of this, but this pullback was absolutely massive. Back down into this box, it was 1800, but then once it settled out in the box, then yeah, it was 1200. Just a massive pullback. So for purposes of what we're doing, I mean, we've obviously got a little bit of reduced volume right now, but
hey Shane, real quick, I don't know if the screen's frozen, but are you trying to share the website with the volatility report?
Oh, yeah, I am. Oh, I'm sorry. Looks like I got a little like, sorry about that, guys. Realized I had my screen paused.
Okay, there you go. All right, it looks like you're good to go now. So,
Okay.
okay, thanks.
Okay. Yeah, thank you, Wade. So anyways, what I was kind of getting at is just that this pullback that we had on Euro Aussie is was around 1800 pips. So anyways, volume is just really up high on Euro Aussie. We went into a box, we've got a little bit less volume, but you know, now we're starting to look for things to uh, start moving again. We've got a new expansion line to work off of, and you know, there could be some good trading in there. There was a lot of other pairs that looked very similar to this, but we didn't feel quite as good about them because there was no boxes. And you know, after a big move like this, you really want some architecture to be able to manage your stop off of, and you know, just kind of give you a basis for how you can kind of manage your trades and everything. Um, anyway, so that's if anybody has any questions about Euro Aussie, I felt like it was fairly straightforward, but you know, if you have any questions on it, go ahead and type them in. And then the next pair that we've got up here is New Zealand dollar versus the Canadian. So let me go ahead and switch over to that. All right, so this one has actually gone up a little bit since we first made that report. When we made the report, it was somewhere in here, so it's gone up about 100 pips or so. Um, so this one kind of same deal. This one actually showed a little bit more on the weekly. So we had a weekly box inside of the report. We mentioned that you know, we were thinking about including it in the week last week's. So last week's volatility report, it would have just been this single candle shooting down and taking out this liquidity, but that's a little bit suspect when we see something like that. You know, just a single candle shooting down, taking out very prominent liquidity levels, you know, and then we don't see much liquidity down below it. It seemed like there would be a strong likelihood that we could get a reversal. And we see that it, you know, whipped around quite a bit in that little area. So anyways, it's starting to work out a little bit better now. It, you know, in technically inside of the uh, a weekly view, we're still short, but if you look at some of your smaller time frames and, you know, temper your expectation to what's going on with those, then there's some pretty decent opportunity in here. So again, that would be in the view of trading like a 15-minute into a 4-hour, like I've got up right here. And then one final thing that I really wanted to point out about the volatility report, you'll notice that we didn't have any directional bias on any of these. So typically we'll go through and, you know, if there's something that we see about you know, about one of these pairs that kind of tips us off to some of the clues that we're looking for, then, you know, we'll go ahead and write it. The only problem with these, the pairs that we had this week, is that we were in on the larger time frames. We were in a bit of a trend to the short side or the long side, and what we would basically be looking at is kind of a breath. So these are still technically in retracement territory, where it could just be a little bit of a retracement, and these could continue in trend. So, you know, we felt like it was important not to, you know, put a direction out there when we know it could so easily just turn around. There wasn't as clear of things as there was in last week's report, like pound CAD. Oh, and by the way, I got a lot of screenshots from people that were able to pull some good trades out of pound CAD. That one ended up working out really well. If you got in somewhere around the daily average price lines to the short side, That was like a 400 pip trade down to the short side. So good job to everybody that was able to catch that. And yeah, that pretty much sums up the volatility report for this week. Again, there wasn't a whole lot going. It took quite a bit of time just going and trying to find some decent opportunity, looking at all the different pairs and different time frames on it. You know, this is not to say that there's obviously a lot of movement in the market right now and good trades to be found in a lot of pairs. But, you know, if you're looking for something that's new out of the box and you're not, you know, for trying to keep out off of the tail end of the big trend and wondering if it's, you know, you're about to rip the very last candle in whatever the trend direction is to have it go against you. You know, so just trying to stay in something that's just starting to move, that's what these pairs would be. But you know, there's still a lot of other good pairs that you can go take a look at, and I think, you know, that's pretty much what Wade's going to be talking about right now. So anyways, if you guys have questions about the volatility report, I'm going to be in the comments and going in through and replying to them while Wade is going through, so feel free to type any questions in. And yeah, anyways, that being said, I'm going to go ahead and hand it over to Wade. Thank you all.
All right, thanks Shane for taking us through that. Appreciate it. Give me 1 second. I got to change presenter here and get my screen set up, and hopefully I don't mess it up. Okay, so I think that's good there. Okay, and hopefully you guys can see my screen okay. If you could, actually, can you guys type in a Y and just let me know that you can see it? I want to make sure I'm good to go before I take off here. Okay, perfect. Looks like we're good to go. Okay, so you guys didn't type in a whole heck of a lot of questions for later. There was volatility report questions, but not too many. So hopefully we got a few more questions that come in. I did jot down some that I wanted to address. So let me get into those, and then I'll go through and see if I can find some more here. One thing I want to address real quick was my comment last week about the coronavirus. My wording was that I felt it was a bit overblown, and I've got not a lot, but a few comments of people. You know, yeah, I'm sure if you're dealing with it and you're in the trenches with it, that it doesn't seem overblown. If you're, you know, especially if you're sick with it, or, you know, obviously, you know, you're going to be right up there. My comments, all I was referring to is that it's just all consuming on the news. Is just every single channel. It's just all day long, every day. So there is definitely a lot of hype around it. And you know, sometimes the media uses that, you know, in situations like this to boost ratings and to do, you know, do things. So that's more what I meant. But anyway, I don't want to offend anybody about it, you know, and we're certainly not insensitive to the fact that it is, you know, it's a going concern. Obviously, you know, I'm sitting in quarantine here in California, you know, not able to do anything. So believe me, it's obviously affecting things. But anyway, just wanted to make a comment on that. I apologize if that offended anyone. I don't want to offend anybody. And anyway, hopefully, you know, we want you guys to be safe and take precautions. And the best thing to do is listen to the local authorities and, you know, whatever they're saying to do to keep safe. You know, we just want to follow that direction and keep everybody safe. So anyway, I just want to address that real quick. Other than that, the coronavirus is obviously adding a lot of volatility to the market. So from that standpoint, you know, there's a lot going on, and as traders, we thrive on volatility. So, you know, from that standpoint, it's you know, we look for economic change to happen, and that's what creates opportunity. The worst thing for traders is when nothing is going on, because what ends up happening is you just get stagnant sideways markets in general. So anyway, from that perspective, it creates opportunity. Okay, so I'm going to go through. There was one question from Benjamin earlier. It was saying, could we possibly include Euro USD in the volatility report every week? And I want to address that. We would always include Euro USD in the volatility report if it's setting up. The purpose of the volatility report is to find things that are fresh out of the box, that are basically getting ready to move either up or down. And then we have a fresh threshold price, the expansion level, we have a fresh expansion level to work with to manage that situation around. So, if the Euro USD was setting up on the higher time frames, we usually look at the 4-hour, the daily, and the weekly. If it was setting up on those time frames every week, then it would be in the volatility report every week. But if it's not in that criteria, and then it's something we're going to leave alone. So, just wanted to clear that up. That is the purpose of the volatility report, is to find things that are ready to move on the 4-hour, daily, and weekly time frames, because we know that if they're getting ready to expand on those time frames, whether it be up or down, there's going to be typically some nice trending days for those of you that are trading the 5 and the 15-minute chart. You know that if a daily is going into expansion and it's fresh out of a box, all those lower time frames below that daily are going to be swinging significantly. And so that's really the goal of that report, is to just tell you, hey, this is something you may want to keep your eye on. Here's the threshold price. Here's what we generally expect. But either way, whether it goes up or down, you have that management price of that the threshold price, to base your long or short bias off of. And that's pretty much it. And that's what the main goal of that analysis is. So anyway, Euro USD, will have it in the volatility report along with any other pairs that are setting up. But if they aren't setting up, then there's no sense in including it in that in that report. Okay, that being said, Thomas had asked if we can go over Euro USD and Pound USD. So I'm going to go ahead and do that real quick. Just do a quick top-down analysis on it. We're going to start with the monthly and the daily. Okay. Okay, so the monthly is obviously, we got a huge whip on the monthly. We're still kind of settling around this last average price right here, but we're starting to get under that. So I'm starting to feel, as far as the monthly time frame, that we're headed short. That would be kind of my overall directional bias for the monthly. We're still under this last expansion, so it really depends on the activity that we get, and really depends on holding below this price. If you start to pull up on the monthly and get above that, that's where I would start to change my opinion on that. But again, it's my opinion. So that's kind of where I would say to look out for that. In the daily, there's no trade going short on the monthly right now unless we start to get a red candle. If we get another red candle going short, you can sell that and then control your risk right above this active high right here. Those trades, if you do that, you're going to want to make sure you're in the money right away and that you control very tight risk on that. What ends up happening in situations where you get these types of opportunities, let's say you do get a red daily candle and you sell it, you don't want to really, that's kind of a momentum trade. You're really looking for it to take off and go towards these lows right here pretty much immediately. You don't want to ride it all the way back to the expansion, because that's really the last level of structure you have to work with. That's not, you're trying to work to get towards this low, and you can't have a downside that's far away, that far away. It's not a great risk to reward ratio, obviously. But if you're working it, if you expect it to immediately go down, from here to the top of this candle to the bottom of this last daily run, that's much better. You're looking at least 1-to-1 getting down there, which would make more sense. So if you're gonna rip the daily short into the monthly, just keep that in mind. If you take your loss above here if you need to, and then see if you don't get up into here, because if you get up into here and it turns, then you can head short. That's a much better place to manage your risk from. So just keep that in mind. Okay, let's get over to the daily here. And then we're going to switch this to a 1-hour. Okay, so the initial daily is going long right now. So let's see how it changes with that. Okay, so we got a green candle on the daily. Now it's against the average price. So this is kind of a fade against the trend. So you can trade these, but you got to be careful. Right now, one thing that I see is that we came down through on the 1 hour. We took out this liquidity line. And then if you see this candle right here, it came up and it tested this expansion level, or it got close to it. And now we're starting to get a rejection off that. That is sometimes a clue that if you were going long on this daily as your directional bias, when you stop making progress through expansion levels, you start getting rejections, that's a clue that hey, you need to look out. Doesn't mean it still can't come around, but in order for trends to make progress, you need to get through these expansion levels, the current ones you're working with. And if it's going to go long, you got to get through this one up here, and then this one up here, and then these liquidity lines. The market makers need to use those lines to boost the trend, and not, hold it up too much at those levels. So when you're working on a trade idea, you need to make sure you need to understand what behavior has to happen generally for your idea to work out. And you're basically going to look for clues that reinforce that idea. And when you get things that go against the idea, you need to start wondering, okay, do I need to adjust my viewpoint? And so that's a situation right there. If you were long, this had a chance right here, and it still may come back up. But let's put it this way: if you were long right here off the liquidity line or at this rotation, you get below this low right here, that may be a good place to just say forget it, take a small loss, see if it doesn't come back down. You may get a better entry, because of the fact at the end of the day, if this is going to keep going long, if that candle's in a whole green, any small losses you would take trying to find that entry, as long as you're vigilant with it, you're going to make back up, because you're going to eventually find the turn of that trend. And you just got to work with these levels of structure to figure out where they're going to turn it from. But anyway, right now, that's one thing I would see. If you are long, that's a clue right there. Okay, let me switch over to the 1 hour. I don't know if someone put a trade in this demo account. Might have been my kids. So I have this computer up, so. Okay, let me switch over to, we got 1 hour. Let's get us a 5-minute. Okay, so now we're going to zoom in for some quicker opportunities. The hour's short. Now, if you're looking at that, remember, if you're long on the hour, this would be kind of a discouragement for that long trade. But what does that mean? If you're trading a 5 into the hour, that's reinforcement that the trend is probably going to end up going short. Now let's look at that. You have a situation where you break out long, we come down, you come back up, you hit this liquidity line level, you get a big reaction. The hour is short. And this is now making me feel like if you are in a short, that you definitely want to hang in there a little bit longer. We are getting a little late in session, but right now, seeing that's the big thing that everyone asks: how do you know when price is settling? Well, you don't know. It has to break out to start an expansion level, but you definitely know it settles when it actually settles. If you see that, if you want to wait for price to have a reaction to a line, you can wait for that confirmation before you ever take a trade. No one is making you trade the breakout. You don't have to get every single move of the market to do okay. So you can wait till you see clues like that, and that reinforces your directional bias, and then you can start trading some of this short. If you're selling right out of this box right here, you can do that, but you'd have to control your risk right basically above this expansion level. Because you got to think, if you're expecting the trend to continue down, maybe your profit target would be the liquidity line level down here. That's probably, where, I would probably, my opinion would be to shoot for this level down here. If that's going to happen, you're going to have to gap from this liquidity line down to this liquidity line. And if you're just going to sell into the breakout, you could do that. But if you got to ask yourself, what if I sold this trade right now, what has to happen for it to go in my favor? What general behavior has to take place, and what will take place if it's not going in my favor? And what's going to take place is it'll get to this level and get through there. At that point, you got to give it some room, and you need to be prepared to take that loss. And so you need to calculate that risk before you ever take the trade, and you need to decide if it's something that you want to do. But other than that, this is showing reinforcement to the downside. So if you're looking to rip the 5-minute, I would not be anything but short. And that's that's pretty much it. So good, probably the best entry so far. There was a test on this one right here. He broke high, could have shorted right here on the turn. He got down through expansion, but you can see we didn't hold below. So at this point, when you get back up through, you want to cut that. I'm going to call that a break-even trade, maybe a small loss, very small, shouldn't be. But you're getting this rejection. When you get back up to a liquidity line, also you have a level of structure right here with the previous expansion level. Again, the trend hasn't changed. It just means it's breathing out a little bit more. It's until this changes full blown, this is a possibility for a better entry. So you can re-enter a short right here, and now your same profit target is getting down through this expansion level here. And it did go sideways. This can be a little difficult to ride through, but your trade placement should have been pretty strong. So even through this, if you can hang through some of that noise, when you're in the money, it's much easier to hang through noise than it is when you're out of the money. So that's really the goal with getting a strong entry into the trend. Kind of buys you the right to sit through some noise, and then you can be in for when it starts breaking. But anyway, this is actually a pretty decent market that's happening right here on the 5 into the hour. So hopefully some of you guys have been trading this. And
Wait, I wanted to bring up one thing.
yeah,
So on that 5-minute entry that you were just going through, the little bit better one where it came up and rotated off of the older expansion line, took out the liquidity line, and then also started coming down. If you look at the 1 hour, it came down, and then you can see that that's happening right at that old expansion line level. So, you can pretty much set your watch to that happening. That when it reaches an old expansion line, it's pretty much always going to have some sort of reaction to price where it'll either go through a breath or rotate back the opposite direction. So in this case, the trend to the short side was kind of well established on the 1 hour chart, comes down, goes to that expansion line, goes through a little bit of a breath, and and then judging by the entry that it threw on the 5-minute chart where it took out liquidity, had a nice little reaction to an older 5-minute expansion line, that those are all kind of clues adding together. One of them happening can be useful, but many of them happening together, it just adds to probability of the trade working out.
yeah, absolutely. And that's one thing, you guys, the directional bias as kind of laid out in the basic strategy is real straightforward. You're either above or below expansion. And what you need to do is like right now, we've been below expansion for hours. So that tells you if you're trading the 5 into the hour, if this is your time frames that you're actively managing, um, what you're doing is you're just looking for clues in the favor of your directional bias. You're completely ignoring the long side of the market. So that's kind of what keeps you forward thinking in the right way, and you're not getting sidetracked. Because the worst thing to do is to trade against trend, um, and then get married to an idea that's not playing out, and then all of a sudden you miss a great entry that was in trend. And if you only made yourself have that one track mind where you're like, look, my directional bias is short, I'm only going to focus on being an excellent seller of the market, or vice versa. If my directional bias is clearly long, I'm only going to focus on being an excellent buyer of the market. So I'm only looking for clues that reinforce that directional bias. For when it comes to entry, that'll definitely help you so you don't get sidetracked. The worst thing you could have did right here in a situation, this is what amateur people would do, is they would see this reaction, they would maybe sell the market right here, they would see it going, they'd say, oh, forget it, I'm going to catch it on the buy side, or they jump in as it comes up here, and now they're in a buy trade that has a low probability of working out. Even if it did work out, that'd be the worst thing because it just reinforces a bad habit. So what ends up happening is that now you're long thinking this is a reversal, and in reality, that's a perfect setup to come back into the trend. But now you're long, and your horse, whatever trade you're in, you liken it to horse racing or something. It's like, yeah, whatever horse you bet on is the winner. It has to be, right? So once you make a commitment to that side of the market, you kind of lose track of what's really happening, because now it's like you're only looking for your horse to win. So anyway, something to think about. I don't want to belabor that too much, but anyway, that's what I see happening here. So the next market I'm gonna look at is pound USD. I'm gonna look at that one. This was also a request from Thomas. Um, I'll try to go through this one a little bit quicker. And then when I'm done with this, I'm going to kind of surf through and see if we could find some more questions to answer. Okay. So pound USD's had a nice run short. We're definitely short on the monthly. However, it's pretty extended, but definitely you're only looking to trade the short side of the market. Similar situation of what's going on in Euro USD. The fact that you got this one long candle here on the daily could be a rotation, but I'd be interested to see what the hour looks like and see what's going on. But overall, that monthly is definitely short. There's no trade right here, but again, if you do come back short on the daily, you see a red candle, it's another one of those quick momentum trades. You got to control your risk real tight, because otherwise, if you're wrong, your downside as far as structure of what the market has given us to work with is clear up here. So you don't want to short trying to get to here with your stop up here. It's definitely not worth it. So no great trade at this, in my opinion, right now on this particular time frame. Okay, so we're long on the daily, but still under expansion. So right now, ideally, you'd much, rather trade coming away from expansion. Let's take a look at this last run. Look at that thing. So opportunities to sell straight out of the box. Again, if you're going to sell out of the box, you already knew you're short on the daily over here. You can sell out of the box, but you got to manage your risk up around the expansion level. You don't want it, because if it comes all the way back, you can let it dance around that level. But if it gets up through there, you got to understand that, it could be, you're going to range out there probably for a while, possibly. So you can sell these straight out of the box. For instance, let's look at this one. This actually is a little better for what I'm talking about. Okay, see right here, this one, it broke long and then it got below expansion. Once you get below, what you really want to see, remember, we're talking about progress in the direction of your trade idea. And obviously your idea should be short at this point. What you want to see is you want to get below and you want to hold below. It's okay if it comes up and tests it. There's noise you got to live through sometimes, but overall, see, then it tests again. And now it's like, okay, now you're getting work. Now you have a new box, new architecture. This one breaks to the short side. You see it broke, come back, test. That's showing great progress in the directional bias, which was clearly short. That's what you want to see. And if that behavior is not happening, that's where you guys got to start to second guess what's going on, and be ready to call call it quits on a trade and take a small loss or a break even. That's where being vigilant as a trader really comes in handy, because a lot of you guys, when we get people, especially newer people that come on, they'll take much bigger losses than are necessary, and it's really, I think it's just a simple problem of just lack of screen time and experience, which you can make that up with just getting more experience. But you don't want to have where you're getting clues and behaviors that are not in favor of your trade and you ignore those. You don't need to take bigger losses, because the clues they're going to clue you in to what the possibilities are. And remember, you're looking for progress that's in your favor rather than against it. And that's what'll keep you in the trade. And you have these levels of structure to work with. They're extremely accurate. Go back and test them. Go back and look. So if you know that you're short over here, you're just looking. These rejections are great. They're great to reinforce the idea. And then right here, you have kind of a classic pullback. If you didn't get in on those, you rip the turn right here, come back through average price. They boosted off of this liquidity line. As we get through average price, remember, we don't know if this is going to happen or not. But once you get below, if you rip this trade, you get below, and where's your stop go at this point? Stick it right above here. Because remember, in order to make progress in the trading idea, you cannot have price coming back up too far through these average prices. It's had its shot. You're in the money. It's either go or no go. And if it decides no go, time to cut it. Take the break even trade, wait for a whole brand new setup, and then try it again. Anyway, so same thing right here when you got down in the bottom here, break out long, sell the rotation, you get down below, see it gets held up right here on that level, boom, here it is, you're in the money, it's showtime, what happens? Rotates, comes back up through that level, forget it. So you call it, you maybe take a profit from here to where you get the rotation, because this right here, if it was in a keep going, it would have respected this line better than that, and it didn't. It disrespected it, and now guess what? You're all the way back up to here. Now what are you in? You're in expand high, expand low, expand high, classic expansion, which means sideways markets typically. You got that clue back here of what the general nature of the market was going to turn into possibly. So again, that's what it's about. It's about having the directional bias, and it's about looking at the clues the market gives in real time as we get new structure. That's what ATS is supposed to do. It's supposed to give you that reliable structure in real time so that you can make decisions quicker than any moving average or any lagging indicator would give you. A lot of people are waiting for the price just to cross over a moving average. You may have got a box that was giving you clues that there was no more progress to this trade a long time ago before a moving average crossover. And that's the real time that we're trying to look for. That's where you got to keep your mindset on. Okay, so I'm going to switch this over to a 1 hour.
You know what, real quick, Wade, I wanted to bring up something about that. A lot of people, you know, when I get some messages over to support just talking about trades, for those of you that have heard or that have gotten a response that had something to do about price forming a bias to one side of liquidity, that moved down in the pound like what was trending. It was very obviously trending to the short side, but it mostly was not taking out any red liquidity lines. It was just seeking out new green liquidity, just going further and further down. And then if you look at the hour, the second that we took out a red liquidity, I mean that, you know, you can see that the trend short is mostly over for the moment, but that's pretty much what I'm referring to, that it just keeps on seeking out new green liquidity.
Yeah, I definitely.
When it's in a trend, it'll kind of, it won't retrace on you and take out liquidity of the opposite side. It's just got a bias towards one side of the market.
Yeah, in a steaming trend where it's just like full blown going for it, you'll definitely notice that it has a bias to one side of the liquidity depending on the trend. So again, it's about clues. It's about, you have a puzzle and you're getting pieces and you're putting that puzzle together, but you're doing it in a single direction. That's what you know, where the magic is you're putting it in that putting the pieces together in that general direction. On the 1 hour, if you're trading the 5 into the hour on pound USD, you knew you were long down here. Okay, we're above average price, so now we're only looking for clues that reinforce the long side of the market. Same thing right here. You get below average, get below your box. That's kind of where it starts. So here's probably your first opportunity that you would have ripped in just this last, you know, what's going on up here. Right here as it goes, it has a chance to go. It doesn't get up to average price. Boom, that right there. Take a break even on that red candle. Take a loss because it's probably going to pull back farther. You're going to have a chance to get a better entry. What I like to do sometimes, if it depending on how the architecture is forming, if you get a short breakout, you're against your hour, which is still above expansion over here. So you're still long. You're definitely not trying to short anything at this moment. If you get a box like this, you can see this box is lower than this last box. Sometimes I really like to buy these breakouts right here, just straight out of the box. The minute you break long, stick your stop right below the average price of that box, because you're still. Some people are like, well, I don't want to buy the breakout. I want to wait for a retracement. But you can buy the breakout because you're still aiming for this reference point. So you're still buying under this average price, which makes this a generally safer situation to buy the breakout than normal. So something to keep in mind. But let's talk about this right here. your reference point, if the trend is going to keep making progress, what needs to happen at this point? You got to get through this level. You got to get through it. We did. We got through it, came through a liquidity line, got a reaction at that level. Right now, it turns, and then you get this aggressive move back through this level. Well, you should have been in down here if you did get in, if you bought the breakout. Maybe if you're hanging it out there a little bit more, you bought this rotation down here. You could do that and control your risk down towards a low. I like to see the structure happen a little bit more. That's why I like to see the box, but you could have done that as well because you're still long in this market. Anyway, you get up through average price like this, and what needs to happen? It needs to start bouncing and holding above that, and we need to go for a run. It needs to go for a long run. If that's not happening, clues, you're getting clues. This is a clue. Forget it. When it comes back through here, boom, you cut it. Cut it right there because that's a sign it's not making progress. Now you got this green candle holding below, the body's below right here, this last level. And now even this one tests the level again. Clues. You should not be riding this trade all the way back down and taking a loss down here. You had the clues back here. That told you what the deal was. Again, I know it takes experience and time, but that's what you're supposed to be doing. You're testing entries. You have your directional bias, but when you start getting clues that are against your trading idea, and it's not making the natural progress it should make, you got to start calling it what it is. And ever since that happened, what has been the general trading environment? Yeah, there's been some other opportunities, but you know that you're basically ranging out at this general level as was started by this box right here. So anyway, I'm not going to belabor that anymore. Hopefully that makes sense, guys. But that's really all it's about. It's about feeling really good about your directional bias and then finding clues and levels of structure to work with that limit your risk and your trading at the decision points of the market, so that if you're wrong, it's a small loss. If you're right and the trend continues on the higher time frame, you have the potential to knock it out of the park. That's pretty much it. So let me, that being said, let me go through some questions here. Shane, if you want to add anything to that, to what I said, go ahead. I'm going to take a few seconds here and scroll through and see if we got any more questions. And guys, we like to keep these around about an hour, so we'll probably give it about another 15 minutes or so. And I apologize if I can't get to your questions. There's sometimes, especially towards the end of the webinars, we get piled on. So worst case, if I do miss your question, feel free. You could always send it in to support@tradeats.com. We'll be happy to answer your questions that way as well. But anyway, I'm going to go through the questions here for 1 sec. Just give me a moment.
Yeah, there actually was something I wanted to add to that. On the 5-minute chart, when you see, so on the 5-minute chart on the right-hand side, the third box in, when it comes down, gets to the liquidity line and then snaps through gets to the expansion line, then snaps through the liquidity line and then stalls out right there. That's always a good indication of something might be happening to go in the overall direction you're looking to take it in. And what I mean by that is you are reacting to an expansion line. So, the market started to stall out right there, and then we snapped through the green liquidity line and continued just to stall right around that level. So that's two things that are in your favor right there. So the way that you'd manage your risk off that trade is set your stop just a little bit below the low that took out the liquidity line and manage it that way and see if it goes in your favor. So, and then on the reverse side of that, if you see on your smaller time frame or any time frame for that matter, these types of clues, but they're going in the opposite direction, that means get out of your trade. So what can be the best entry ever can also mean get out of your trade if you're in a profitable position or you're looking for it to go the opposite direction. So I think that's something that kind of gets glossed over sometimes. The same clues that mean a good entry also mean get out of your trade because it could be setting up to go the opposite way against you.
All right, thanks, Shane. I'm sorry, guys. I'm trying to write down a few questions here I want to address. I'll quickly address this question because I could do it quickly. From David, the question was, I think you're new with us, David. Welcome aboard. The lack of training in the Heikin-Ashi candles and the IREG, I'll address that. I probably do need to do some sort of formal training on Heikin-Ashi candles, but I think if you guys watch them, I think Heikin-Ashi candles are like some of the simplest, most straightforward things you can look at on a screen. I don't really know how much more there is to tell about them. We use Heikin-Ashi. I'll tell you why we use them as a preference is because they really smooth out the market phases. If you look at regular candles, you can end up getting wrapped up in the noise, the opens and the closes and the candle bodies and the dojis and the hammers and all the other great pattern names that they have for candles. You start getting wrapped up in that, and you start losing the sense of the flow of the market. The Heikin-Ashi candles, I mean, this is not something we invented. Heikin-Ashi candles, you could download these from MetaTrader's website. They're usually included in the platform, but they just show a flow of the market that, in my opinion, is really, really helpful in not only helping you see the market clearly as an overall what's going on, but also helping you hang in some trades. And they also work amazing for holding your directional bias, in situations like that. So overall, I do know that they can lag a little bit, but I'll tell you right now, overall, the benefits over the lag of changing color or in certain circumstances, I think they far outweigh the benefits of the consistency in color. So that's why we use Heikin-Ashi candles. I think it's an amazing candle that was invented by, I don't know who invented it, by someone else, but they've been around a long time, and they're a great tool whether you're using ATS software or not. I always recommend people use Heikin-Ashi candles just because I think they, like I said, they smooth out the noise and keep you focused on what matters. So. And then the IREG is, again, we have a template in there that has the IREG. Again, the IREG is not an indicator we invented, but I included it because a trading group that I was part of years and years ago, that was a kind of a key indicator we all used to use. I don't really use it too much anymore because it does have a repainting kind of, I don't want to say it's a quality, but it does repaint if you adjust the settings. And so I have, recommended settings. I keep it rigid. If you are going to use it, keep it rigid, super straight, setting of a 1.0 or a 1 on the rigidness of it. And actually, I think now I'm thinking about it, I forget which webinar it is, but if you go back, if you're really interested in the IREG, I believe I did a training, and Shane, we need to label those webinars. That's something that we need to do, but I did a training on a webinar about the IREG and the recommendations and how to use it. So again, I apologize. I forget what week it was, but if you want to know, you really want to know about it, you can go dig through some of those old webinars because there's a lot of content in that. And one of the webinars was based on just, using IREG. But
Hey, wait,
anyway,
just to input on that, it's about 5 or 6 weeks back that you did it.
okay. All right. Thanks, Dad. Okay, so yeah, 5 or 6 weeks, check around there in that neighborhood. And like I say, it was all about IREG. But anyway, just to get to the quick story about it, we used to use it as part of a trend trading system that we used a long time ago. And some of the traders that started in ATS with me came out of that group. And I just put it in there because we used to use a version of that code on FXCM's trading station back before they got banned out of the United States. For all that kind of craziness that went on. And so I just found the similar code. It's actually almost the same code, and just included it for them that were used to using it. Other than that, it's a standalone indicator. It's not, or ATS is a standalone indicator. You do not need IREG to use ATS. It's just a secondary thing. I put it in there for the friends that came with us, when we started ATS and moved to MetaTrader 4. So anyway, it's not super important, but if you want to play with it, you can. You could change around the settings. It can be useful in helping you kind of see the highs and lows of the trend. But again, if you adjust it to where it's really showing curves and aggressiveness, it can throw you off because what ends up happening is it feels like, okay, the market's turning, but it's really not, because the thing that's most important is the architecture of the market. That's your exact levels. with the expansion levels. That's what we're going off of first and foremost. So you don't want to put anything on your screen, whether it's IREG or anything else that's going to take away from the most important thing and cloud your judgment about the market structure. So that's just my opinion. You guys could do whatever you want, but just my opinion on that. But anyway, I should probably just do a training on Heikin-Ashi candles too. Like I said, I don't really know what to say about them other than they're smooth and consistent and they work well for what we do. You just gotta get used to them.
And found it. It's in the February 18th webinar that you did.
Okay, February 18th webinar in the webinar archives in the online course. Apparently that's the one that I did the training on IREG, so you guys could check that out. Okay, so let me keep scrolling through here. I'm going to try to find a couple more questions, and then we'll probably go ahead and wrap it up. So hang on.
By the way, I want to apologize real quick. It's not Adrian, it was Andre. Sorry.
Okay, I'm going to take a quick look at Frank Yen. I think that was it. Hold on, let me. Yeah, okay. This was from Mohammed. I was asking if we could take a look. There we are. Okay, there was no specific time frame, so I'm just going to do a quick general. Okay, that monthly's starting to feel long. You see, remember the clues. We had a chance to come down. We're getting rejected above average price. That's kind of reinforcing that monthly trend. If this continues, it doesn't have to happen, but that's a great clue. Remember, that's a great clue for reinforcing a monthly trend. I would say, that this monthly, there's a great chance it's going to go up to this expansion level and then maybe beyond up to this liquidity line level. So that's kind of the general distance that I'd be looking for if you're trading on that time scale. And the daily, so yeah, there's your snap down right here. And if you're long on the monthly, you're above average price. Here's that kind of that similar situation. You break low, hold below, you get another big snap, but your time frame's still intact over here. If you're really betting on the monthly continuing, so you break long again right here, see price come down. This is kind of a dirty market. It's pretty whippy. But it did come down, held structure right here. That's why I say if you trade the breakout, you want to kind of manage your position around the expansion line. If price got down into here, then it's probably forming a downtrend at that moment. But right here, that's again a clue in your favor. If you're expecting the monthly to go long, when you see that, that's if you're not in already, you can even buy the market right here on this rotation because you got clues in your favor, and now you have a respected level to manage that trade off of. You notice that even on this daily candle, it wicked down, and now it's even farther away from that level because it already had proven respect of that level. So putting clues together in your favor, in the favor of your directional bias, when you get enough clues with a good management point, then you take action. Okay, so that's what's going on those time frames. The daily obviously is long with that directional bias, and that daily looks like it could be setting up on the long side. I think this may have been in the volatility report.
Yeah, it was in last week's volatility report. We were talking, the thing that I put in the volatility report is that, it was kind of a range. There wasn't really an overall direction of the market. It was just whipping back and forth, just going sideways. But then we whipped down, took out liquidity, and then you can see the expansion line. It kind of lines up perfectly with those lows, which is kind of an indication to me anyways that, we basically sucked up the liquidity that was down below all of that. And then, then we got further confirmation of a potential long when it rotated off of that expansion line. And that kind of says that they're protecting long orders. And now we're starting to raise. So that gets a little bit into the weeds though. But, you didn't need to know any of that stuff. All you need to know is that it rotated off the expansion line on the daily, and you should be looking to manage your risk off that or something a little bit tighter on your entry time frame. So,
yep, pretty much. And if you're using the daily as your directional bias and you're trading, let's say you're position trading on the 1 hour, if that's your time frame, well, let's take a look at the architecture on here. So right now what's going on, came out of this range, whipped down right here. The daily, I have to check the times, but we went green on March 19th. Yeah, 19th, 20th, we started going green. So in this situation, you pulled up right here. If you notice, as you pull back down, see how you get close to this level of structure, not only right here, but this previous level. You can see it held this previous level almost to the pip. So you can, in these situations, if you feel good about your directional bias, which in this situation at that moment, probably would have felt great about it because you're seeing the rejection. This is telling you market's long. And if you know the daily, if you feel confident that the daily is going to continue to the long side, then that means that every time frame under that, the big moves are which way are they going? They're going to the long side. So when you're down in a situation like this, if you were trading this pair, you pull down to these levels of structure, can you buy that right there? Can you buy that rotation? Yeah, you can, and you can monitor your risk off of these two levels right here, because again, it's a question of clues and progress in your directional bias. That was a good reinforcement of that clue that you're coming down, you're respecting these levels, and then you get a reaction from them. You can buy that with low risk because it's in your favor. There's no guesswork. We're not trying to figure out long or short. We're only looking to the long side because we like the nature of what happened over here. And until you guys have that sense of knowing that where you feel great about that higher time frame and it all lines up, you don't need to make a trade. You don't have to get in the, there's nobody sitting there holding a gun to your head saying, you need to make a trade right now and it better win. Nobody's doing that to you. We, as traders, I've said this before, I'm going to say it again, and I'll probably say it a million other times. We control very little. We can basically have zero control over the market. We can't make it go up. We can't make it go down. But what we can do, what is 100% in our control, is the environments that we choose to expose ourselves to. And nobody is telling you that you have to make a trade that has a bad risk to reward ratio. No one is telling you that you have to be in a trade because you're a trader and you need to make progress today. Nobody's doing that. So wait till the situations become clear. Make well-calculated decisions where clues are in your favor, you have structure to work with, and then get in when the odds are in your favor and there's low risk. That's it. That's all you have to do, regardless if you're using ATS or not. These are widely taught principles. All the best traders, if you read Market Wizards, you read, there's a great book I recommended. I'll recommend it again. It's Think and Trade Like a Champion by Mark Minervini, who's actually a stock trader, but his methodology is very similar to what we do. He talks about his volume contraction pattern he uses, which is essentially buying a breakout out of our boxes. Except I believe we have a lot more architecture to work with. His is actually kind of a more simplified approach to it. But anyway, extremely successful trader. And he has some great stuff in that book on psychology. I definitely recommend you guys pick up that book. It's a really good read. But it's by Mark Minervini, Think and Trade Like a Champion. But yeah, same thing. It's like, it's about having a tight risk and having a decent upside, at least a 1-to-1 to start with. And then what controls your win rate is the consistency of your higher time frame. And so, if you reverse engineer into your trades, you start with a directional bias that isn't, completely extended. It hasn't already gone 12 candles long, or 15 candles short. Find something that's in the sweet spot right here. Find something that's fresh. That's what the whole volatility report's all about. It's about finding this opportunity. That's why it was on last week's volatility report. It was close to this. It had a fresh expansion. It's close to the decision point. It's something you may want to take a look at. So, you know, find those situations and find the clues that reinforce your direction, and then take action. And again, if it's not good, if it's too, you know, too far gone on the trend, then just wait till it's not. It's just
I
about,
just want to add into that real quick, Wade. Yeah, on this pair, this, you know, you said when you first pulled this up, you said, "Wow, this is a little dirty right now," but it's dirty and whippy right up until it's not. You know, in 2 weeks, you know, now that it's setting up in 2 weeks, we'll look at it and be like, "Wow, what a great run that had. That looks like it was easy." And the way to get into those moves before they happen and have some confidence that there's, you know, the best days are ahead of you is to trade markets that are just setting up instead of, you know, wow, you know, look at how far this pair's run. If you're saying that, then, you know, kind of by default, that means that you might have missed the real trade. And then one other thing that I wanted to bring up is if you could go to the just leave the daily up, but on the hour, if you could go to the 15-minute, I was actually watching this last night and there was a really, really nice entry in there to the long side. Down there. So we formed that that second box down to the low. It came up, tested the expansion line, and then and at this point, all of this was above daily expansion. It was above pretty much everything it needed to be above. And we whipped down, took out that liquidity line, and then started eking our way up. It was like I was watching that thinking, wow, I should really be in that trade right now, and kind of took off from there. So those are always little clues that it's gonna, you typically won't even get an entry like that if it's not gonna run. So that the entry itself tells you that it's getting ready to move.
yeah, talking about this move right here, again, like what Shane was saying, if you're using the whole purpose of the higher time frame is to keep you with a one track mind. That's so you're not getting caught up thinking, okay, this is definitely a short move, and now all of a sudden you find yourself selling it right here. No, because your higher time frame, the stronger, more powerful time frame is still above expansion. We still have this clue of this reaction. So you're anticipating getting through the average price and working your way back up. Because if this is going to follow through, guess what? The farther you pull away from here, you know, from this expansion level, you can calculate it at this point on this rotation. You measure up to that line. There's, you know, it's 810 points that you can calculate your general upside, because in order for the trend to follow through, you are going back here. If this stays long, you can absolutely count on you're getting at least to this level, just like what happened here. Now, when it comes down to looking for clues, I see there's some comments about the clues. Hopefully, I've addressed the clues throughout this process. But going back here, again, it's not making progress quite yet. You can see you're still rejecting, you reject again, but now we see we get more architecture. You see how it's getting tighter and tighter, and now we got these expansion levels, and you see right here, you take out that liquidity line, price gets through, and then boom, you get this increased volume move up through this expansion level right here. That's a clue. Can you buy that? Absolutely, you could buy that. You can buy that breakout as you come through that expansion. And where do you control your risk on a situation like that? Right here at the turn. Because again, it's a question of progress and trend. If this is going to make progress, and let's say you bought right here, you got to get through here. That's the first level of progress. Get through this level. Boom, obviously you explode. Clues are in your favor at this point. Where's your next level of progress? You got to get through here. That original last point. Did it make it up through there? Yeah, you hit that level, and you see we got a reaction off that level. You very well may have closed the trade. You took it from there to there, great. But eventually it did work up through, and now here's a situation where you're below average price. You're still long on the daily. You get up through, okay, you're in the money. If you get on the rotation here, you're up through. Again, what needs to happen? Progress to the upside. What happened right here? This is not progress. It turned down. Now, if it ricocheted off that line and bounced, that's progress. That's a progressive clue in your favor. Did it get through? Yes. So what do? Close a trade, break even. This is defining a new expansion range. This is telling you it's time to sit out of the market, wait, see if it doesn't breathe down further, give you some more architecture to deal with, and maybe possibly buy another breakout, because you know what? Facts are we're still long. It just wasn't ready at this point. But that's the key. You got to put those clues together as you go along, and that's what's going to help you make the real-time decisions that you need to make, much faster than any other basic indicator, confirmation signal, or anything is going to give you. You got to combine the market architecture with the price action, and use that. And it's like I said, if we're gonna call it a theme today, it's progress and clues in the favor of your trading idea, or non-progress and clues against that trading idea. Think about it from that perspective and use that to let you help stay in a trade, or say that I'm not going to be in this trade anymore. And sometimes, you know what, you'll call it wrong. There's always another trade. There will be another trade. There will always be another trade, especially in this economic environment. There's a ton of movement right now. Remember, you need to be in trades that you understand. Don't get tips from other people. Don't ask, what are you thinking? Believe me, we spent years sitting around a oval table, confusing each other and others with our opinions. Form your own opinion, stick the trade, work out your trading plan, and then eliminate things that cause confusion, and work your trading plan. You have to get to that point. That's how you have to do it, because no one's going to see the market exactly like you do, perfectly, and no one's going to be able is going to care or work your trade as diligently as you will. So make sure that you're operating from that standpoint as well. But that's kind of a different subject for a different day. Anyway, I'm going to see if I could find one more question here. Okay, here's a question from Nikki. Wade, do you still like the week and the 4-hour time frames, or not anymore? Yeah, absolutely. The weekly using the hour or the 4-hour, it really comes down to what you can effectively manage. And for us in California, there's some times where, a lot of the times where if we want to catch any of the big moves, or we want to be in the market, we have to look to the higher time frames, because some of the big moves happen when, at midnight, and unless you want to trade all night, you have to use those larger time frames. So yeah, it doesn't matter what time, all the time frames work. There's no benefit, except I will tell you, if you get down to a 1-minute chart, then you have to be really concerned about the spread, because your average trade win is going to be smaller on a smaller time frame, and then the spread ends up becoming a much more significant percentage of your winners, or your commissions that you pay is going to take away from those. Whereas, if your average winner, let's say, is 50 pips or 100 pips, ripping a 1-hour chart for entry, the spread becomes pretty, it doesn't really matter at that point. But if you're doing several trades on a 1-minute chart, you do have to make sure that you got a tight spread, and that there's sufficient movement on those time frames to justify trading them. But other than that, for Nikki, just the daily, or the daily into the monthly, hour into the weekly, 4-hour into the weekly, depending on what suits you better, all good. They all work, and they all will set up at different times. There could be different opportunities on different time frames. What I suggest is you pick one that you can. It's the most important part, is that you can manage it effectively. So if you're have to go to a day job, or you have to go do something, that you don't want to be trading a 5-minute chart on your cell phone. That's not effective management. You do not want to have risk in the market, and you're sitting there trying to, manage it on your phone, or work that out. So you're going to have to move to a higher time frame, like an hour or a 4-hour, because if you're trading a 4-hour for entry, and let's say you're using the weekly or the monthly as your directional bias, it doesn't change. We're still looking for the same clues to reinforce our direction. It just is going to happen slower. But it's all the architecture, the behavior, all identically the same. But when you're trading a 4-hour, if you check that market, you want to check it at least once every 4 hours. And if you have a day job or something you're trying to balance, that may be a much more effective approach for you, rather than, if you're trading a 5-minute or a 15-minute, there may be a critical decision that needed to be made, 30 minutes ago and you were, seeing a client or you're doing something else for your job, and you couldn't make that decision. So that's number one thing. When I used to do coaching calls, number one thing I would ask the person, you're trading? What time frames are you trading? And if they say I trade the 15-minute and the 4-hour, the next question I'd say is, do you work during the day? And this is a diagnostic process. I'm telling you, it's consistent. If they say I trade a 15-minute chart and yes, I work a day job, I would say, okay, that's your number one problem. Ditch the 15-minute chart. Get rid of it. Because there's no way. You may have some winners, you may be able to get some things, but it's going to throw off your consistency. It's just too fast. It's too fast to be able to make the decisions you need to make quick enough. So anyway, yeah, I still love the 4-hour and the weekly. I love all the time frames. I love the time frame I love the most is the one that you can effectively manage and be there to make critical decisions. That's the one I love the most at any given time. So let me see if I can find one more question. I know we're getting over here. Okay, for any of you guys that have seen gold, they actually shut it down on FX Choice. The market has just been really whippy, and I actually chatted with FX Choice earlier today just because I know a lot of our guys trade gold. I want to kind of get to the bottom of what the deal was, and it's basically just comes down to it's a lack of liquidity, which I would think that the markets are extra active, but there's a lot of volatility and a lot of risk going on with that volatility, and that causes the markets to act kind of funny. You'll notice, like with the situation, let me see if I can pull up gold real quick. It seems to be back on now, but just a little bit ago it wasn't running. But yeah, it's like 730, 700 point spread. It's normally like 21, or 40. But if you look at the 1 minute chart, you can see how dirty this.
Your 1 minute is still Frank Yen.
Oh, that's okay. I moved it over here. So ignore this side. But anyway, you look at this 1 minute chart with that wide spread. You look at those candle bodies. Obviously, this is not a market you'd want to try to trade. And you'll notice that sometimes you'll get a lot of this kind of action right at New Year's, like on the right around New Year's when the market is super thin. Every year I look at that because I remember there was a year, this is like almost 10 years ago or something, where I was sitting around with my dad and Shane. We're sitting in an office we used to call it the lab. We had like, I don't know, like I think we had like 8 32-inch monitors, and we had this huge trading room, and we were sitting there at New Year's. This is when we were still pretty beginner. But I was like, man, what is going on with this market? Because I'd never traded through New Year's at that point, and it looked just like this. Super widespread. Now, obviously, coming back this long, you look at this market, there's nothing tradable there. So you definitely want to stay away from gold and wait till it gets back into the normals, gets a tighter spread, starts opening up a little bit. But anyway, so FXCM said if it closes down, it's because it's a lack of liquidity from whatever liquidity providers are using, however they're handling that. Or I say FXCM, I meant FX Choice if I said that. FX Choice, it's a lack of liquidity. When you got things like this, you want to stay away from this market until it starts flowing again. But I know you guys are smart. I don't need to tell you guys that. All right, guys. So I apologize if I didn't get to some of your questions, but I do really appreciate you guys being on. Real quick, as far as announcements, again, I told you last week. I think we're probably around a month to a month and a half out. That was last week from the update with the expansion index and the new indicator suite. We are making progress through that, and I'm hoping to get an update here in a day or two that we can do some beta testing on. Anyway, just want to keep you guys posted with that. Appreciate you guys hanging in there. I know economic times are difficult for some. You guys that are hanging in there and still trading, regardless. One thing I will say though is that on one hand, if you're working a job, I sincerely feel for you if you're getting squeezed for not being able to work right now, especially if you're under quarantine and dealing with what we're dealing with in California. But on the other hand, how thankful and grateful should we all be that we have the privilege of understanding and even having the opportunity to do something like Forex. Because at the end of the day, I know it's a difficult business. It changes on a daily basis as far as how you got to approach the market. It takes a lot of discipline, but at the end of the day, where else can we find something where it's just us and this screen? There's no boss, there's no employees, you don't have to go sell anything. I mean, it's still is just the most incredible opportunity, in my opinion, that exists. And I know that's why I originally got drawn into it. And I'm assuming that's why a lot of you guys are here too, because it's so worth it to put in the hard work and get the screen time. Because at the end of the day, when you have the skill set, even though, you got to keep up your skill set, you got to it's like, it's like sports. If you don't practice, you get sloppy. So you got to continue to keep up and keep your skill up. But at the end of the day, you can take this skill anywhere with you in basically any country with an internet connection. No one, once you know how to do it and you know how to approach the market, you know how to control risk, you have a solid approach, no one can ever, ever, ever take that away from you. And even in times where we got pandemics and we got craziness going on, we have something that we can still work at, and only gets better as far as volatility wise and price movement. It gets better, unfortunately, with unrest. So like I said, not taken away from people. We care about you and your families and hope everyone's safe. But same thing, and maybe reflect on that, is that this is a great privilege that we have, and we need to take it seriously, and we need to do our best to respect the markets so that they take care of us. So anyway, I'm gonna leave you guys with that. I really appreciate you guys being on, and we'll look forward to seeing you guys on next week's webinar. Thank you so much. Bye-bye.